Hello friends, in this investor world, many of us has heard about lot of products like investing in equities, debentures, bonds, options. But one of the lesser known product is CFDs, Certificate Contract of Difference. Not only the product is lesser known, but the regulations behind it, the risk behind it is also not very well understood by the investors. And today, based on the local regulations in DIFC, we try to understand and demystify certain important aspects of the regulatory requirements, especially from the compliance point of view. So let's understand what exactly is CFDs. CFD stands for Contract of Difference. Now this is a contract between the buyer and the seller that states that the buyer must pay the seller the difference between the current value as well as the value when the contract expires, which means you buy something now expecting that the price will go up, and then you sell. Either you make a profit, and if the price goes down you make a loss. So you can do the trades on both the sides. If you are expecting that the price will go down, you sell now and buy later. And if you are expecting that the price will go up, you buy now and sell later. So this is an opportunity for the investors and the traders to profit from the price movement, but most importantly, without owning the underlying assets. Now, how we distinguish it within the equities is generally if you are purchasing equity for the long term, when you make the payment, the equity come to you into your demat account, and then in the future you can sell it at any point of time. So you have the shares lying into your demat account. But in the CFDs, the CFD is just a play between the price difference, and either you win or lose, you gain or you lose. The value of the CFD contract does not consider the assets underlying value. The only thing which is considered is the price movement. And in this kind of contract, there is no exchange or futures exchange involved. It is a contract directly between the client and the broker. He just plays, as I said, in the price movement. Now let's look into certain important regulatory definitions which has come to ensure the investors protection in this area, and how this is getting implemented. So one of the definitions is the restrictive speculative investment, which means it is an over-the-counter derivative which is a leverage contract for differences. So what we have just shared as a contract between the price difference, a leveraged rolling spot futures contract, forex contract, an option over a contract which is just referred in one or two, and any other leveraged investment similar in the nature to an instrument referred in the top three. Now what is leverage? Leverage is a temporary loan which is extended by the counterparty or the other party who is going to settle the trade. Suppose you are the buyer, so there would be a party or a counterparty who is going to sell. So one who will settle the trade. So what they do, they give you a leverage. So suppose you are investing of $100, so they may give you a leverage of say 1 is to 100. So you can have an exposure of $100 into $100, which is $10,000. So wherever there is a price movement, the profit or loss is on the total 10,000. So the profit is also on that higher amount and loss is also on the higher amount. So leverage refers to a person's exposure which is getting multiplied by the gain or loss based on the actual value. Similarly, margin is a pre-agreed amount a retailer pays in the form of money to open a position in relation to restricted speculative investment. For example, you are buying any asset, yeah, anything in the oil or gold or any other currency. So assuming that the total exposure amount is $10,000, and the regulatory requirement is that you should have a margin amount of say 10% or 20% depending upon the risk involved. So on the total exposure, you have to keep the amount as say $20,000. OTC is the over-the-counter derivative, which is an instrument which is traded on an exchange or a regulated exchange. Now let's go into the contract for differences and look into the regulatory definitions. A contract for difference is an instrument that falls within the paragraph B2 of the definition of the future in the general module, which you have just shared below, and which is other than a rolling spot forex contract. So first of all, let's look into the definition of the future. Future is an instrument comprising rights under a contract where the value of the contract is ultimately determined by reference or in part to the fluctuations in the value of the price of the property or the index rate, or any combination of this, exchange rate, or any other factor designated for that purpose in that contract. But the main difference is which is settled wholly by cash or set off between the party. So here there is no delivery, and excludes those contract where there is money is received by way of deposit or an acknowledgement from a debt, or terms that any return to be paid on the sum deposited or received will be calculated by reference to an index, interest rate, etc. So to explain in brief, it is a contract where there is no underlying any asset or security, but purely you pay on the difference of the price and there is no delivery. You have to settle the transaction by cash or settle between the parties. And as the definition has mentioned, other than a rolling spot futures forex contract, so a rolling spot forex contract is an instrument as stated in the definition of the feature, except that the contract is ultimately determined by reference wholly or part to the fluctuations in the value of the currency. Now, because this product is also offered to the retailers, so not all the licensed brokers or the traders offer this product to the retailers, but keeping in mind that the risk is high and the retailers are not aware about the margins as well as the total exposure and the risk involved. So there are stricter regulations to keep the regulator to the investors to be informed about the risk they are taking, and they know that what kind of risk they are taking as well as very specific disclosures. So let's delve into the details. So first of all, when when the product is offered to a retailer, there is an appropriate assessment which is done, which means that the person who is going to invest has adequate skills and expertise to understand the risk involved in the trading of this restricted speculative investment. We have seen the definitions, and he has the specific ability or the specific ability to absorb losses which may result. In fact, the losses may extend to the total amount of margins which he has kept with the broker. And on the reasonable test, we ask that the investor has sufficient knowledge. And how do we test the knowledge? How often and to what volume he has traded in the type of restricted speculative investment in the past? What has been his knowledge, experience? Does he understand the characteristics of the risk involved? What are the underlying assets, the degree of volatility, the price which may affect the underlying reference? Understand the impact of the leverage, which means suppose he has a leverage of 1:100. So if he is putting money of $100, he has an exposure of 10,000 and the loss or gain is on this total exposure. And not the least, he has the ability in terms of the asset and the liquidity to absorb and manage any losses. So as an institution, we need to see that this reasonable test is done. There are specific systems and controls to ensure that the right product is offered to the right investor. There are predetermined clear criteria who can invest, who cannot invest. There are records kept to understand how the assessment has been arrived at, and also periodically the assessment is reviewed to see that if there is any new product, whether it is materially a different risk from what has been offered to the investor, and whether there is any change which is a material in terms of client circumstances. For example, if someone is near to the retirement, whether this product is suitable to him, no, because the risk involved is very high, he will not be earning later. Or suppose a person who has a job, he is losing the job, or a person who has a big business but he has made some significant losses in the business, and thereafter whether this same product is suitable to him, because he may be suffering future losses again and he may not be able to absorb that. So what are the risk warnings which are required for a retail investor? That the type of contract with the persons entered into are complex financial instruments where the loss or profit is determined by reference to the movement of the price of the underlying reference. This type of trading is complex, high probability of a person losing money rapidly based on the fluctuation of the price of the underlying reference. Before deciding to trade in this restrictive speculative investment, a person needs to understand carefully whether they understand how these products work and whether they can afford the risk of losing money. And the risk warning is to be given in writing before opening the account. A quarterly standalone statement is also to be shared with the investor, which includes the percentage of the such account that has made loss during the given period. Generally, suppose it's a new business for the last 12 months, and if it is a part of the group company, the performance of the group company in the last 12 months, as well as the losses which has been made by the retail investors as a percentage of the total, either 12 months or since inception. And the data has to be presenting a fair and balanced view, not just cherry pick data, and it has to be not misleading to the investors. And the disclosure should also include the type of restrictive speculative investment for which this warning has been given. Now, the earlier warning was relevant for the retail investors, but these are the general warning in relation to anyone who is investing in CFDs. So, this warning is set out on the marketing and other communications in a clear, concise, and easy to understand manner. If it is offered on a website or an application like a mobile device, the warning is statically fixed, which means on every page that warning remains static in spite of the changes in the paper or the page, and visible at the top of the screen. So even which the person scrolls up the screen or move it down, that static disclosure remains, and it is included on each linked page on the website. So let's look into some of the examples of the disclosures. So here are the few examples of the disclosures which I picked up from the website. So if you look on the second one, spread bets and CFDs are complex instruments, come with a high risk of losing. It also mentioned what is the percentage of the retail investors have lost money. 73% have lost money. You should consider whether you understand this and whether you can afford to take this high risk of losing money. In the third instance, again mentioning that are complex instruments, 84.6% of the retail investor lose money. In the last case also, it is mentioned 73.7% of the retail investor lose money. You should consider whether you understand how it works and whether you should afford to take the high risk of losing the money. So this disclosure are very clearly mentioned prominently on the website's top page. So based on this and understanding that the risk involved are high, the regulators have revised recently the margin requirements, which means the amount of money which the investors need to deposit with the brokers. So if you see earlier, the amount was the leverage or was given 50:1, which means only 2% of the money he has to pay of the total exposure, which has been changed to 10%. In gold, 5%. In some minor indices, it is 10%. Shares 20%, and in crypto, it has gone up to as high as 50% because of the high volatility. And it also mentioned for the major forex pairs. What are the major forex pairs? USD, GBP, Euro, JPY, and others. And major indices are FTSE, Wall Street, Germany, Hong Kong, HS50, Australia, Singapore, Spain, and other details. So other important regulatory changes on the margin closeout requirements for the retail clients. So net equity in the retail client's account should not fall below 50% of the overall margin deposited in that account. So net equity means the sum of the retail's client net profit and loss and the retail's deposit. So the total amount of profit lying in the account as well as the deposit should not fall below 50%. And where the retail's client net equity, which means the profit and the deposit, falls below 50%, the firm must close all open positions in the client account as soon as the market conditions allow and in accordance with the best execution requirements. Another important regulatory change has been on the negative balance protection. So here it has been very clearly mentioned that the total loss on the CFD's positions will be limited to the funds in the trading account. So suppose the investor has a total amount which is given as say $5,000 or $10,000. The loss cannot exceed the amount which is lying in the account. So maximum what will happen if the loss or the market is falling down, the sale value of the position will be to the extent of the deposit, and as soon as the deposit value is eroded or there is an erosion, that is the maximum loss that the investor can suffer. So negative balance protection only apply to the trading losses. Also, because the product is highly risky, there is a tendency of many traders to offer incentives. Okay, you open the account, we'll pay you an incentive. So the firm must not offer or provide to retail client any incentive that influences or is reasonably likely to influence the retail client to trade in a restrictive speculative investment. And the systems and controls must be strong to ensure that such kind of influence is not there. And these incentives could be bonus offers, gifts, rebates or fees, including volume based rebates, and which is to be avoided. Also, to ensure that the investors are not carried away in terms of the market's way to see that, okay, I don't have too much liquidity, but I can borrow on credit or even borrow on a credit card. Again, as a safety measure, the retail clients does not use a credit card or a third party credit facility to pay a margin. Debit card is allowed because that is linked to his bank account, and even he should not use third party money, because if he borrows money and invests and loses, so that again is a very big risk. So wherever the fund are coming, it is the duty of the process people to see that the fund source is verified. A retail warning is issued to the retail client that a third party credit should not be used to fund the margins, and the retail confirmation is obtained that he has not used any third party credit to fund his account. So what are the restrictions in relation to dealing with this restricted speculative investments? There has to be a transparent pricing mechanism available for determining the price movement, by reference to which the profit or loss of each party to the contract is clearly determined. And there has to be a two-way pricing that allow the retail clients to trade at those quoted price during the currency of the restricted speculative investment. He should be able to view the prices. And also, if a firm is been referred by a person that okay, he wants to invest, such reference should not be through an unregulated person or an unregulated financial institution, because the regulated person and the regulated financial institution are aware about the risk involved, and they will be giving the necessary warning and disclosures. So this criteria has been put into effect. For the firms who are dealing as an agent, arranging, advising, or making referrals in relation to such restricted speculative investments or with reference to a retail client, the issuer is either the authorized firm or a regulated financial institution that we have just discussed, and there is a reasonable ground, there is a proper due diligence that if it is offered by a non-DIC issuer are subject to the same requirements as those which has been applied under our current discussion, and this due diligence has to be taken by the firm before undertaking any relevant services with or with a retail client, and then you should be able to prove on what basis the conclusion had been reached that the investment can be made by such a non-DIC issuer. So that's it on the understanding side of the CFDs, and this was initial uh, discussion on the various regulatory requirements on the recent changes, and hope that you will have a more advanced learning as you go through the materials. And as a matter of disclosure, this is video is only for the education purposes. You are required to go through the specific rule books and take a proper balanced decision. Thank you for your patience, and thanks, and see you again in the next video.